Treasuries on track for their worst month so far this year following that sell-off, and investors are eyeing 3 bond auctions coming up this week. The demand for those auctions is going to be closely watched because that could be an indicator of investor sentiment this week ahead of key economic data releases, including PCE. Our next guest warns that the path forward for the Fed is only going to get harder from here. So we're going to speak with Tom Porcelli, PGIM's fixed income chief U.S. economist. Tom, thank you so much for being here. I mentioned those bond auctions coming up this week, but I'm curious, for the past 3 weeks, we've seen that the 10-year has been higher. The 10-year yield has been higher than the S&P 500 earnings yield, which has been driven by the Mag 7. What is the bond market telling us about that Mag 7 driven rally? Is it telling us that it's starting to stall off here?
Yeah, so thanks for having me. Good to be with you all. Yeah, look, I think what the market is telling you, what the bond market is telling you, is that we're in price discovery mode. I think the market is really trying to get a better sense for what higher for longer means in the context of a Fed that now may not cut this year. So I think, you're probably going to see some volatility. I think, you highlight auctions. Sure, I think there could be some volatility around that. I think the data will always cause some element of volatility. But I think ultimately we're really going to be taking our cue from the Fed as it relates to treasuries. And look, I think the hurdle is growing higher for the Fed to cut rates this year. And in a lot of ways, I feel like my view has become sort of bimodal. It's like I either think they're going to go 0 times or I think they're going to go a lot. I actually don't think they'll raise, and we could talk about that. But I think this is what the market is trying to figure out.
Tom, so what does it exactly mean then for the market if we don't see a cut before the end of the year? What kind of volatility could that ensue? And then as you look ahead to 2025, where does that leave your expectations there?
Yeah, it's such a great and important question because I think, look, we all seem to live in like a snapshot of time, right? And so you'll look at like a payroll report or you'll look at a PCE report, which we'll get on Friday, and say, oh, things look good. And I don't doubt that, right? Like, I don't think I don't doubt for a second the snapshot in time is that things will look pretty good. And I think that might persist, certainly even over the balance of this year. I think the real challenge, though, comes in 25, because I do think that the reality is rates are in pretty restrictive territory. You are starting to see some early signs that there is some sort of, stress starting to build in the labor backdrop. Again, I want to stress, yes, I get it. We're printing 270,000 jobs. What I'm saying, labor or forecasting anything requires that you sort of drill deep. And so I do think that there are some signs that things are starting to slow down to some extent. And what I would stress is when I look at the consumer in particular, what we have to keep in mind is the consumer is the only way the consumer's been able to drive consumption is to really drill deeper into saving. I mean, they're really using saving to support current consumption. And of course, using credit. These are not totally sustainable. So what I would argue is as you roll into 25, I think things start to look a little worse, particularly if the Fed has not cut rates.
Given that and given the timing of an election coming up, does that sort of force the Fed to either cut in June or have to wait until at least the end of this year?
Yeah, this is a really important question, too. And what I would say is this. Yes, history is littered with examples of the Fed adjusting policy around an election. But what I would also say is when the Fed has adjusted policy around an election, there's been an overwhelming reason for them to do it. Right now, I would argue it's probably going to be pretty debatable. And I think in a debatable backdrop, I think the Fed would want to veer away from adjusting policy. So I think you're quite right. If you don't get the string, right, like Powell keeps on saying he wants to see a string of good inflation reports, that will push the July cut, which they could potentially do, way out to December. Because I think, again, around an election, unless, it's an overwhelming an overwhelming reason for them to cut, I think they're not going to be able to go in September and November. So that would push it out to December.
Tom, talk to me just a little bit more about that and exactly what it would take in order to justify some sort of move surrounding the election.
Yeah, I think it would basically take not just inflation really sort of softening up here, which, again, we do think will happen. It's just not going to happen in a linear way, right? It's like you're not going to get month after month of improvement. There'll be a couple of months where, it's sort of seemingly the improvement is stabilizing. So I think it's not just inflation. I think it's labor at this point. I think you would really need to see labor start to slow down. We do think that by the end of the year, you could certainly see a higher unemployment rate, but it's going to be the combination of labor and inflation that I think would get the Fed to go in September and November. But again, I stress, I think that hurdle is growing increasingly higher for that to happen.
And given that, I wonder what you make about the shift in the hawkish versus dovish tone that we've heard from Fed officials. I'm wondering if Powell sort of started off the year sounding a little overly dovish so that he could hedge any potential pushback about when he may be cutting surrounding the election. What do you make of that?
Yeah, I mean, look, they're at the mercy of data. And again, this is a really important point. You cannot, it's arbitrary to say that you want to see a string of better inflation reports, which again, I think most people assume to be 3. That all seems pretty arbitrary to me. I think you have to have a view on inflation. And I think the Fed's view that inflation will continue to slow down, I think is quite right. I think the view that the unemployment rate will continue to sort of drift higher, right? And we're not talking about things falling off a cliff here. I think that view is also quite right. And I think if those are the views that you hold, then I think it's very reasonable to want to take back some of the aggressive tightening that the Fed has put in place. I think if that was your framework, I think that it would be very easy to make the case for cuts this year. And interestingly enough, that is the Fed's framework as of right now. But I think they're being swung around by single monthly data points. And look, I get it. The prior month number was pretty firm too. But again, I think it's the preponderance of data continue to suggest that you will see this continued slowing in inflation. But I think the Fed is very worried about credibility. I think that they've really sort of staked their view on we need to see inflation moving in the right direction. And because it's not going to be linear, I think that does create the improvement will not be linear. I think that does create a higher hurdle for them to cut.
Tom, I'm curious, before we let you go, we got to talk about the soft landing versus no landing debate that's happening right now. And it seems like when you take a look at the surveys, when you take a look at a lot of the recent notes that have been published here over the last several weeks, investors are increasingly starting to expect this no landing scenario.
Yeah.
How likely is that? And then ultimately, it's got to land at some point, right? So then does that raise the odds of a soft landing or actually a hard landing?
So let me tell you, I hate the landing idea. It's too much. Because you don't really ever fully land, right? In fact, I would say if you want to keep it in aeronautical terms, then we operate at different altitudes from an economic perspective, and we have been operating at a very high altitude over the prior couple of years on the sort of in the wake of the post-pandemic period. Where now the altitude is now slowing. Again, slowing from a pretty high pace, but we think that economic activity is slowing. So that to me is a totally reasonable and fair way of thinking about the backdrop. But as I said earlier, the risk will grow for sort of a much slower economic activity or backdrop. The higher rates stay here.
Tom Porcelli, it's always great to speak with you, and I'm with you on that whole no landing scenario. The landing, way too much has been made of it, but we got to ask you about it because that is what the people want to be talking about right now and want to know exactly how it's all going to play out. But Tom Porcelli, PGIM's fixed income chief U.S. economist, thanks so much for joining us here this morning.